Wall Street once believed some companies were untouchable, so permanent you could buy and hold forever. In the late 1960s, brands like IBM, Coca-Cola, and Xerox were not just admired. They were the Nifty 50, the can't-fail picks for every serious investor. But when everyone bets on forever, price stops mattering, and that is when things get dangerous. What happens when forever breaks? The answer changed fortunes and rewrote market history. By the early 1970s, the numbers told a story that should have been impossible to ignore. The Nifty 50, those so-called permanent winners, traded at an average price-to-earnings ratio of 42. That was more than double the S&P 500's 19 times earnings. Some of the biggest names like Polaroid and McDonald's soared past 50 times. Even Coca-Cola, the definition of a blue chip, hovered around 30 times earnings. What do those numbers actually mean? A price-to-earnings ratio of 40 or 50 is not just a label. It is a BET. If you buy a stock at 50 times earnings, you are accepting a 2% earnings yield, just $2 of profit for every $100 invested. In a world where Treasury bonds offered 6 or 7%, that kind of trade only makes sense if you believe the company will deliver relentless, compounding growth for decades. No missteps, no slowdowns, no shocks to the system. But the math gets even more fragile when you look at the bigger picture. Those high multiples did not just reflect faith in the companies. They assumed the entire economic backdrop would stay friendly. Low inflation, steady interest rates, no sudden competition. If any of those levers moved, the justification for paying 40 or 50 times earnings would vanish. The market priced in a version of the future that left no room for error. The result was a set of expectations that could not bend, they could only break. And when the environment changed, there was nothing to cushion the fall. The higher the starting point, the longer it would take for reality to catch up to the promise built into those prices. That is why the stakes were so high. Every extra turn of the price-to-earnings ratio was not just optimism, it was exposure. It was risk, hiding in plain sight. Inside the boardrooms and investment committees of the early 1970s, the logic behind buying the Nifty 50 felt airtight. Portfolio managers didn't just chase these names because they loved the companies. They needed them. The pressure to match or beat peers was relentless, and the safest way to protect your job was to own what everyone else owned. If you filled your fund with Coca-Cola, IBM, or Johnson & Johnson, no one questioned your judgment. If the market turned against you, you could point to every other major institution holding the same stocks. Career risk didn't reward independent thinking. It punished it. Liquidity sealed the deal. These blue-chip names traded in huge volumes, making them easy to buy or sell without moving the price. That mattered when you were responsible for billions in pension or endowment money. In committee meetings, justifying a stake in McDonald's or Procter and Gamble was simple. These were household names, with long track records and glowing analyst reports. Nobody got fired for sticking with the crowd. A feedback loop took hold. Analyst upgrades and bullish research flowed through the financial press. Mutual funds, insurance companies, and bank trusts all benchmarked against each other, reinforcing the consensus. The more these stocks climbed, the more they looked like proof of their own safety. Social proof replaced fresh analysis. The underlying message was clear. If you didn't own the Nifty 50, you were the risky one. Institutional herding didn't just inflate prices, it locked the market into a narrow set of assumptions. The crowd stopped asking hard questions about value and started treating consensus as a substitute for due diligence. The result was a kind of groupthink that made the danger invisible, until it wasn't. Every stock carries two stories. Story A is what the business actually does, its sales, profits, products, and how it stacks up against competitors. Story B is what the market already believes about its future, the expectations built into the current price. In the Nifty 50 era, Story A for many of these companies was impressive. Dominant brands, strong growth, relentless innovation. But Story B was where things got stretched. Prices soared not just because the companies were good, but because investors assumed the good times would last without interruption. Take IBM. Imagine it's 1972 and someone tells you IBM will still be a major company in 20 years. That sounds like a green light to buy. But the real question is, at what price? If the market is already pricing in 20 years of dominance, paying 50 or 60 times earnings, your upside is squeezed and your risk is hidden in plain sight. This is where the idea of multiple compression comes in. Even if IBM kept growing, if the market decided to pay less for every dollar of profit, the stock could go nowhere for years. The business story and the expectation story can move in different directions. That is why separating the two is essential. It is not enough to know the company is strong. You have to know what is already baked into the price. Coca-Cola kept selling soda, kept growing, and kept dominating shelves. But for anyone who bought shares at the peak, the reward was a long stretch of waiting. The stock price barely moved for more than a decade. Dividends helped, but the returns lagged behind the market, all while the business itself stayed strong. That's the pain of overpaying for greatness. The company wins, but the investor waits. Polaroid's story unraveled faster. Once celebrated for instant photography, Polaroid traded at sky-high multiples in the early 70s. Then came new rivals and changing technology. When the market's expectations cracked, the stock collapsed. The business never recovered its old shine. Xerox followed a similar path. Its copier empire looked unbreakable, but competition from Japan and new technology cut its margins and its mystique. The price investors once paid for certainty turned into years of regret, and that regret was financial. Not every story ended with disappointment. Walmart, a late arrival to the Nifty 50, outperformed everyone. Investors who bought Walmart in the early 70s saw annualized returns near 30% for decades. The difference wasn't just the business, it was the timing, the price, and relentless execution. These outcomes weren't random. They were the real-world results of mixing narrative, numbers, and the price you pay. Turning lessons into tools means asking sharper questions about every so-called forever stock. Start with valuation versus history. How far above its usual range is the price? If a company trades at 30 or 40 times earnings, what growth rate does that assume for the next decade? Right now, Nvidia sits at a multiple that dwarfs most of the S&P 500. That price bakes in years of blockbuster, AI demand, and flawless execution. The gap between today's price and historical averages is not just a number. It is a map of how much future success the market already expects. Next, look at breadth. Is the rally broad with many companies pulling their weight, or is it narrow, with just a handful dragging the index higher? In the Nifty 50 era, leadership became dangerously concentrated. Today, mega-cap tech, Nvidia included, makes up a massive slice of the market's total value. When gains depend on a shrinking group of names, the risk of a sudden reversal grows. Finally, check for sensitivity. What levers could move the story? For Nvidia, the entire narrative depends on relentless AI spending, continued data center buildouts, and the absence of major regulatory or geopolitical shocks. Any slowdown in capital expenditures, a change in export rules, or a new competitor could snap the chain of assumptions, holding up the price. In the next episode, 3 charts will show how quickly these stories can unwind. You will see how valuation, breadth, and sensitivity all played out in the Nifty 50 collapse. Once you see that, you will never look at a cannot-miss stock the same way. Today's market darlings trade at valuations that assume years of flawless growth, just as the Nifty 50 once did. When expectations outrun reality, history shows even icons can disappoint. The only thing permanent in markets is change. What narrative are we buying into today?